Well, hello, everyone. I hope you are doing excellent today, and welcome to the Benjamin Z. Miller Investor Networking Group. We have such an exciting presentation to go over today on the subject of mortgage note investing. We're going to be talking about being the lien lord instead of being the landlord. And we'll talk about how this can be something that is very beneficial to you to consider these sorts of investments, how that is just fantastic. So let's go through everything here. And first of all, let's talk about landlord versus lien lord. Everybody is familiar with the idea of you're a landlord, you're going to go buy some apartments or some houses, or maybe throw in an apartment community or two if you're a bit if you understand economics a little better. But then there's also the lien lord, and the lien lord is on the paper side of the business where you go around and you purchase up the actual mortgages. So instead of buying the real estate, you buy the mortgage that secures the real estate. This can be quite powerful, as a matter of fact. One nice thing about it is you are not limited geographically. Most of the people that do real estate investing, they like to invest in their own little farm market. They say their farm area, and that is great for them. But if you want to invest in other areas, it's far easier with mortgage note investing. So what is a mortgage? Just to review the basics of it, is a mortgage is an agreement that is between a borrower and a lender that gives the lender the right to take the property if the borrower fails to repay the money borrowed plus interest. So it actually is an interesting word. It comes from French. It literally means dead pledge. If you translate it, mort is dead in French and gage is pledge. So it's kind of an interesting word. And the reason they called it that is when mortgages were first taken out, people would die. They would never live until the end of the mortgage. And that's why they called it a dead pledge, and it's kind of an interesting term. Okay, so let's look at an example note purchase. Let's say that there's a property that sold for $120,000, and let's imagine that a buyer put down a $20,000 down payment. So the seller of the property agreed to allow the buyer to make payments over time at a 10% rate of interest with a starting note amount of $100,000. Now, let's go through how this might happen, because some of you are saying, well, I'd never pay 10% interest on a loan. Well, I understand that feeling. Now, here's the thing. With this, the situation develops because the buyer, let's say he goes to the seller and says, hey, I want to buy your house. I want to buy your house. And the seller says, great, it's $120,000. Pay me $120,000 and I'll sell it to you. And the buyer says, well, I don't have $120,000. I've got $20,000 that I've saved up. Can I pay you $20,000 and then I'll make payments? I'll pay the other $100,000 off. And the seller says, oh, no, that's not how this works. Let me educate you. You go talk to my banker, John, and John, he's a good banker. He'll get you a loan, and then you come back after you've got a mortgage, and then you pay me all the money. And the buyer says, okay, I'll try. And the buyer sits down in John, the banker's office, and John looks him up and down skeptically and says, listen, you've got a low credit score. You're self-employed. I don't like to loan to people that are self-employed. Can't you get a government job? Couldn't you get a job with the government? You're self-employed. I don't want to make a loan. I mean, unless do you have like a good credit score? Oh, you don't have a good credit score and you're self-employed? Get out of my office. Get out of my office and come back when you've got a good job, and when you're no longer self-employed, and when you have a high credit score, and then I'll make you a loan. So then the buyer goes back to the seller and says, listen, I talked to John, the banker, and John said no. He said he wouldn't do it, but I really want to buy this house. I'll pay you. Let me make payments over time. And the seller at this point, he's had it on the market where he tried to sell it, and he got an offer of $105,000, but that just made him angry. That made him so angry when someone offered him $105,000. And then he got an offer of 112,000, and that made him angry too. And finally, this is the only guy that will pay 120,000. So the seller says, you know what? I'm tired of this. I'll sell it to you for 120,000, but I'm not going to loan it to you at a low rate of interest. I'm not going to give it to you at a bank rate of interest. It's going to be a 10% rate of interest. And the buyer says, hey, that's fine. I'm happy to do it. So how much do I need to pay you? And the seller gets out the calculator and says, well, you need to pay me $877.57 per month. And the buyer says, okay. So that is basically how that goes down. And let's imagine that this note has been created. Let's imagine that this hypothetical buyer has made payments. He's been so good. He's made payments for 60 months straight. He's never made a payment. He's never not made a payment. He's so accurate. So now that note has an unpaid balance, and we'll go through on another slide just to review how that looks, of $96,574. And let's imagine that the seller now wakes up one day after 5 years and he wants cash. He needs cash. He's had something happen. He has a situation where he needs cash, and he picks up the phone and he calls a company like, for example, Alamo Mortgage Holdings. He calls maybe Alamo Mortgage Holdings and he says, you know what, I'd like to sell this note. And the friendly people at Alamo Mortgage Holdings, they say, you know what, we'll buy that note. We'll make you an offer. And let's say that they negotiate, and the seller says, well, it's $96,574. That's what I want. And the people say, well, you know what, with the highest we can pay is $83,322. Do you want that? And the seller says, okay, I'll take it. And because he'd rather have his cash than wait 25 years for the rest of it. So that's the basics of it. Now, let's look at this chart here. And this is an interesting chart. I'm sure everyone has seen this chart, this type of chart, but I want to point out a few things. You notice how over time, when you're making payments on a mortgage, this shows, for example, a $250,000 loan at a 4% rate of interest. The monthly payment is $11.93 a month. And you see how this blue line, the total balance, is going down. But it's interesting because in the beginning, it's going down real slowly, and then it is increasing as it goes down. That is because the first payments you make on a mortgage, the majority is being paid to interest. And then later, the payments are, more of the payment is going to principal. So that is something that is important to know, because this is when you're making an offer on a note, you need to know what's the unpaid balance. Okay, so now let's talk about what are some of the advantages of mortgage investing. Oh, and there are so many advantages of mortgage investing, folks. First of all, it's less time and effort. If you're the type of person that loves passive income and you don't want to work and you want to just get the money and not work, mortgage note investing can absolutely offer that to you. You also don't have to deal with a physical property. If something breaks on the property, that's your landlord's problem. You call up your landlord and you say, hey, I made you a loan on that property and I want you to get it fixed. Or you call up your homeowner, you have your lawyer call up your homeowner, and the lawyer says, the lender is concerned about the fact that the property's not in good condition and he wants these things fixed, or he's going to have to take some actions. So you don't have to deal with any of that. You can just have your lawyer notify your borrowers that the collateral is not in good condition and that you want it in good condition. It also allows diversification. You can do mortgage note investing from anywhere in the world. You could be in Tahiti, you could be in Rio de Janeiro, you could be wherever you want to be, and you can do mortgage note investing. The power of mortgage note investing, because in these days and age of email and a telephone, they go around the world, and you don't have to be there. So that is a huge benefit, unlike most careers. There's also potentially less risk. This assumes you know how to do mortgage note investing. The people that don't know how to do mortgage note investing, there is a huge amount of risk where they can make mistakes and lose a lot of money. But if you're educated and you actually know what you're doing, it's extremely low risk. It is extremely low risk. If you're a pilot, if you know how to fly a plane, it's not very risky. But if you sit in the pilot seat and you are not trained, just like if you're doing mortgage note investing and you're not trained, it's risky. But the point is, it potentially offers less risk if you know what you're doing. So let's talk about what determines the value of a mortgage note. There are 6 factors that determine the value of a mortgage note. The first factor is the actual buyer. The buyer that you are making a loan to, that took out the loan, the actual buyer is important, because if you've got a buyer that is, for example, let's say they're a government employee and they have a cushy, soft job with the government where they sit on a comfortable chair with a comfortable desk, and they've been there for 15 years and they get paid like clockwork and they've got their high salary from the government. That sort of buyer is less risky if you've got a buyer like that than a buyer. Imagine you've got a 21, 22, 23-year-old buyer, and he's got an idea that he's going to start the next Facebook, and he is just convinced that he's going to be rich. He doesn't have a lot of money right now, but he's sure that he can make the payments to you if you sell him the property. His tech company is going to go through the roof and be so successful. That buyer can potentially be riskier. So the point is, the buyer has an impact. Who's guaranteeing the payments? The collateral. The second thing is the collateral. Now imagine that there's a property that has a value of $100,000. Okay. Let's say this property is located in Denton, Texas. Okay. And let's imagine that the owner of this property is an amazing salesperson, and they know all the latest tricks, and they have the idea, hey, I know these people from California are moving here. I'm going to take out an ad in a California newspaper, and I'm going to sell this for $200,000, because those people in California, they don't know what it's worth, and they've got so much money. To them, $200,000 is cheap. So imagine they do this. Imagine that he finds that one guy in California that is, busy. It doesn't have a real estate agent, doesn't know what things are worth, and he sells it to him for $200,000. The fact that he got the buyer to sign a note for $200,000 does not change the value of the collateral. That collateral is still valued at $100,000. So the point is, when you value a note, you have to look at the actual collateral. If the collateral is only worth $100,000 and you've got somebody that has a note on that collateral for $200,000, that note is not worth $200,000. You just need to be aware of that. You also need to look at the down payment. Okay, did the person put down $10,000 on $100,000, or did they only put down maybe $1,000? Let's imagine you had 2 buyers. They both came in and they said, you know what, I like this. I'll pay you the money for it. It's, for example, $120,000. And one guy comes in and he puts $10,000 down. That guy has put $10,000 down. But then imagine you've got another guy that came in and he only put down $1,000. Maybe he said, you know what, I really like this and I'm definitely going to pay, but I've only got $1,000 that I can put down. Please sell it to me. And for some reason, the seller said yes. The seller felt something in his heart and decided to do something that made him feel good. And he sold it to him. But now the seller has a note that is far, far less valuable than if he had insisted on a real down payment. So the other thing that's important is the terms, the interest rate. If you have 2 notes and one of the notes, and they're identical, but one of the notes pays 8% and the other note pays 10%, well, the note that pays 10% that has a 2% higher interest rate is more valuable. Now let's talk about the history, the actual history of the note. What is the record of payments? Maybe over the last 5 years, has the buyer always paid on time with no lates, never 30 days late, never 60 days late? He always pays on time, versus another buyer that, he is always 30 days late. Sometimes he's 40 days late. Sometimes he's 50 days late, but he always catches up right before a foreclosure. Those 2 notes have wildly different values. Then the paperwork. The thing is the paperwork done properly? Was it something that was done with lawyers putting together a paperwork, or was it something where two guys are just sitting at a kitchen table and they work out an agreement and they go to their computer and they print up their agreement and they sign it? Because if it's not done properly, the legal paperwork, that can present an issue later in terms of the value of the note. So the pay history is also so important. Okay, now let's talk about what price things should sell for. All right. How do you value a non-performing note? So now we're not talking about a performing note, we're talking about a non-performing note. Okay. So let's imagine that with the non-performing note, we have a situation where it's on a $650,000 property. How much would you offer on a $650,000 property? You're not buying the property, you're buying the debt. You're buying the debt that has you're buying the mortgage, you're buying the note, you're buying the note that has the right to foreclose, to take ownership of this property, because the person living in the property hasn't made a payment in 18 months. And the seller wants to sell it. And the seller says, well, it's 650,000 and there's all these penalties and fees. So it's risen all the way up, to much higher. Why don't you pay me 714,000? And then you would say, no, I don't think so, Mr. Seller. I think I'm going to pay you 30% of 650,000. I might go up as high as 70% of 650,000, but that's basically where you're going to offer. Now, let's say that it's between 350,000 to 650,000. You might make an offer at between 50 and 70 cents on the dollar. Say that it's less than 125,000. Say it's a property that is priced at maybe 50,000. Well, you might buy that note. We're not talking about buying the property, the note. You might buy that property for 10% to 25% of the unpaid balance. So if it's a $50,000 note, you might offer 5,000. So that is, or you might offer 12,500, but somewhere in there. The reason is, if you're buying from a bank, banks spend a lot of money on foreclosures. For a bank to foreclose, because banks, they're like, we need the best legal experts. So they go hire the best legal experts, and those legal experts charge very high amounts per hour to work. And the legal experts, they know it's a bank with a lot of money, so they're not exactly trying to control their billing when they get work. So they run that bill up. They'll charge $25,000 to, sometimes for foreclosures. And that's not just the legal fees, but, everybody's got their hand out for the bank asking for a fee. The real estate agent wants a fee. Everybody wants a fee. So it just is something that's a situation. So for a bank, it's tempting to just sell it and be done with it. Okay, how should you explain the discount to the seller? Well, this depends. If you're talking to an individual, where it's a person that has one or two notes and they've got a property, they sold it, they took a note, you're going to make it very simple. You're going to just explain, well, the value of the debt's 100,000, but I can only pay you 70,000. And then the guy will be like, well, why only 70,000? It's 100,000. And then you explain, well, look, it's the time value of money. If you want the full 100,000, you can wait many years to collect it. But if I give you money today, don't you think you can make more money with it? If I have to wait all that time. If I go into the grocery store and try to buy groceries, the prices have risen in 10 or 20 years. So this is something that's going to go down in value. You're better off just to sell it to me for 70,000 today, and then you've got it done. Or if you don't want to, you can hold on to it. But it's only going down in value the longer you hold on to it, because every time he makes a payment, the amount owed on it is less. So if you think you can find someone out there that's a greater fool than me, you might be able to. But I'm here. I'd like to do business with you. I think 70,000 to me is what seems like a good offer. Let's just do it. And then that's how you explain it. Okay, now let's talk about buying packages of notes. What about buying packages of notes? How does that work? Well, good question.
Well, this right here is actually an example of what a portfolio of loan notes might look like. So this is actually a real portfolio. And you look here and you can see the name of the borrower, the number of months. You can see the interest rate. This debt is actually pretty high, 14.75% is what they're paying on that mortgage. The monthly payment is $278.50. Then you can see the terms, status, this sort of thing. So, and you've got a list here, and this is an example of a package where a package of these mortgages can be purchased. This type of deal would be done by a larger investor. It would not typically be a single investor that would buy this package. For example, my company, Alamo Mortgage Holdings, this is the type of package that we might actually purchase something like this. But if you're just starting out in investing, you might start out by, you're just going to buy one mortgage note. So for example, you might come in and this mortgage note, if you find something like this out on the market, you might try to negotiate down from, the unpaid balance of $89,570. Maybe you try to buy it for $59,000 or $69,000. But that would be one note. But you can also purchase packages of notes. And that's something that Alamo Mortgage Holdings is involved with. It's a company that's a United Kingdom company that actually purchases packages of mortgage notes. So wanted to give you an idea of what a package of notes look like.
Fantastic. So that's basically how that works. Okay, now I want to talk in more detail here about what can you do if you like the idea of doing this mortgage note investing, but you frankly don't have enough time to invest in learning all of the nuances of it, because it does take some education. It does take a commitment to learn how to do this properly. It's not something that a beginner should just run out there and do without knowing anything. Because if you do that, you can make a lot of beginner mistakes, like confusing a first lien note with a second lien note, paying way too much money for a second lien note. These mistakes are out there, and that's the easiest mistake. But there are many, many mistakes. For that reason, I have a company that can actually help. It is called Alamo Mortgage Holdings. This is a UK company. And let me tell you about Alamo Mortgage Holdings. What it does is it purchases American mortgage debt. And that's a great thing because it provides passive income to our UK accredited and our institutional investors. And then it actually purchases American mortgage debt. So you can get mailbox money. And this is a short excerpt that kind of shows how it works with Alamo. This is really tailored to UK investors, but I'm going to show it to you anyway because it relates to mortgage note investing. And the point of it is you can save yourself so much time and hassle if instead of trying to be a note buyer, you just work with Alamo Mortgage Holdings, because we've got a team that has 200 years of business experience with 100 years in the mortgage and real estate industry in Texas. And when you make the wise decision to invest with us, we handle all these details you're hearing about for you. And you can just get that money deposited into your bank account. It is fantastic. So, okay, let's go through this, and this will give you an idea of what's an alternative if you want to earn passive income, especially if you're watching this on the internet and you're from the UK, you're a UK accredited investor, or maybe you're an institutional investor. Check out Alamo Mortgage Holdings. First, I want to go through an important notice. I want to make this absolutely crystal clear. This investment is only directed at persons certified as high net worth investors. So if you're not a high net worth investor, we are not offering this to you. We're not trying to sell this to you. Before making any investment,
you should read the information memorandum, and you should make sure that you understand the risk factors. This is not an investment with zero risk like a government bond. This does have risk, and I'm going to just tell you that there's always a risk that exists in investing, but as experienced investors, I'm sure you already know that. So your capital interest are at risk. Okay, so let's talk about the mission of Alamo Mortgage Holdings. The mission of Alamo Mortgage Holdings is to provide passive income to non-US accredited investors. So we're not looking for US accredited investors. We're focusing on United Kingdom. We're also focusing on institutions by purchasing real estate-backed mortgage notes in the United States, in the state of Texas, while providing greater liquidity to the owners of these mortgage notes. Alamo will earn money by purchasing mortgage notes at a discount. We're going in and we're negotiating hard to purchase those new mortgage notes at a steep, steep discount. And then once Alamo has that mortgage note, we're able to pay out fantastic returns to our bond and note holders. As an example, let's say that you purchase a private mortgage note that has an unpaid balance of $100,000. And let's further imagine that this hypothetical note has a 10% rate of interest. Let's say that you find a motivated seller, they just need cash, they can't wait 30 years for the note to pay off. And you say, well, I'll pay you, Alamo says, we'll pay you $70,000 cash today for the note, and we'll wait for years to collect the payments. To the right motivated seller, that will be appealing. Now, I know to many of you, that may not be the situation where you would never sell a note that way if you own such an asset. But there are motivated sellers in the world, and we provide a service to those motivated sellers. We're able to get them the cash they need where they cannot easily turn those notes into cash. And in exchange for that, they have to make it attractive for Alamo. So after the purchase, the borrower is now our borrower. So now we have a borrower because we bought the mortgage note. And that borrower that was making payments to the guy that sold us the note, now he has to make payments to Alamo Mortgage. This borrower has now, but his payments have not changed, even though we bought the note at a discount. So our yield on this hypothetical note is 14.2%, allowing us to pay out 8% passive returns to our bond investors. You know, folks, the current low interest rate environment, it really does not provide many options for investors to earn passive income, while also having the safety of capital preservation. Alamo Mortgage Holdings solves this for our investors, for our bondholders, for our note holders, by focusing on acquiring mortgage debt, hard assets, collateralized assets, exclusively in the state of Texas. We have a very focused niche market. We're not a company that's trying to do business all over the United States. We focus on one state. We know the laws in that state. We've got a team that's from that state. We've got 200 years of business experience and 100 years in the mortgage industry. And that's our business. And we are able to offer this passive income to you. We can supply it, and it's something where you can do one investment and for years you can earn passive income. It's not something where you have to do a lot of analysis of each mortgage note. We handle all that for you. So let's go to the next example. Let's say here that there is a property, a piece of real estate in Texas, and the price of it is $120,000. This is a real property. This is an example. This is not something we have in our portfolio. I'm just trying to demonstrate.
So we talked about this earlier, how you can purchase a note. And then we're going to go through here and let's go to the next slide.
First, I want to go through an important note.
Okay. Now this is going to show a comparison of how Alamo Mortgage performs compared to UK gilts. If you're in the United Kingdom, if you're an investor in the United Kingdom, UK gilts or UK bonds. And I'll give you a hint, it does
And
well.
Today I want to talk about something that is very interesting. And this is if you are an investor that's an accredited investor in the United Kingdom, you may be wondering what is going on with the 30-year Treasury gilt yield. So let's take a look at this and talk about it for just a minute, and then we'll compare it to Alamo Mortgage Holdings, our yield. And I'll give you a hint, Alamo Mortgage Holdings has a far, far higher yield. So if we were to go back to, say, the year 1980, the highest that we have here is around 1981. The yields were running about 13, almost 14, 13 and a half, 14%. And then you notice how over time, the general trend has been largely downward. I mean, we look here and we see that the yield as of, for example, 2016, if we look at 2016, the yield's like 1.4%. And then if we go all the way down to May of 2020, the yield fell all the way down to 0.57%. Now it's starting to slowly go back up. And as of this video, December 2022, the yield was at 3.678%. So let's just kind of compare that. Let's imagine that you buy gilt, you would get a 3.68% yield if you were to purchase a 30-year gilt. But now imagine that you instead decided to purchase an Alamo Mortgage Holdings bond. How much would you make? Well, that is a great question. I'm happy to answer it. So basically with an Alamo Mortgage Holdings bond, you'd be getting right here at 8%. That's a tremendous improvement over what you can get on a gilt. Now, I know a lot of people are going to say, but a gilt has a zero default risk. I get it. I understand. But here's the thing, folks. You're getting such a low return on a gilt that you may want to consider if that actually makes sense to you in terms of what you're dealing with there. Because if you were to instead purchase an Alamo Mortgage Holdings corporate income bond, which is the bond of a UK company, you'd be earning right at 8% yield. And if we were to go back in time, you wouldn't have seen a yield like that for many years. You would have seen the last time gilts were giving an 8% yield was looks like it was right around let's see, when was it? 1996, so almost 30 years. So in the last 30 years, it hasn't gotten close to an 8% yield. So that's worth thinking about. If you would prefer to get an 8% yield, and you understand that it's not a government-backed guarantee. It is backed by collateral, though. It's backed by mortgages. It's something that you definitely should consider. Be happy to chat with you about what Alamo Mortgage Holdings can do for you in terms of providing passive income. And I wish you a fantastic day.
So that's something that is relevant, and it's also important to think about that, because people are always looking. But let me tell you where people make a mistake, and I really want to show this illustration, because we're talking about an 8% yield. I know a lot of you that are in the UK. My friends also in the UK, you're sitting back and you're thinking, I don't care about that. I can get an 8% yield already here in the UK. I can even get a 10% yield. Some of you are probably thinking, well, let me share something with you that may be relevant to you if you're in the UK. I'm going to show here a chart of the British pound to the US dollar, the exchange rate since the end of Bretton Woods. Bretton Woods, towards the end of World War II, there was an agreement that fixed exchange rates. And at that time, the 27th of December, 1945, one British pound bought $4.03 American. But now look at what has happened over the decades. And I really feel for you in the UK because you have suffered so much going through this with your currency, where it just is decade after decade after decade where the US dollar keeps getting stronger and your currency keeps getting weaker. So when you're sitting there in the UK and you may be thinking, you know what, 8%, I'm already getting 8%. Well, folks, I'm going to tell you something for you to think about. Okay. I want you to imagine when you used to travel around to maybe other countries in Europe, maybe you came to the United States. Think about how much more buying power your British pounds had. They had a lot more buying power. And now you're in a situation where your pound is losing value, losing value, losing value. There has to be a solution to this. And that's where Alamo Mortgage Holdings comes in. We've got a solution for you where you can actually get that passive income. We can get you that 8%. You can get that same passive income, but we can sell you a pound denominated or a dollar denominated investment. So if you're like, you know what, I don't have a lot of confidence in the British pound, I think I would prefer to go with what I see based on the long-term trend of the US dollar is getting stronger, 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 and my British pound is getting weaker, weaker, weaker. Maybe you're the type of person that wants to take action instead of just sit back and look at the news and read about it. Instead of being the guy that his currency, is losing value, it might make sense to diversify your currency. You could diversify your currency, some of it, maybe some percentage of your portfolio, you take it out of British pounds and you put it into US dollars. But then you're saying, well, what am I going to do with US dollars? We've got a solution for you, folks. Just buy the bond. Buy the bond of Alamo Mortgage Holdings, and then you can get that 8% passive income and you can get away from that British pound. Or if you think that, if you're the guy that thinks that you can predict the change in the exchange rate, that's fine. We'll sell you the bond in pounds. It's your choice. Or if you don't know, we'll sell you half in pounds, half in dollars. We make it easy for you, folks. So just keep that in mind, and it's especially relevant to if you have friends that are in the UK, please share this video with them. I'll repost it, but it's something that's so relevant. Okay, so now let me introduce this next video. I'm going to show a clip here of the team, so you know who Alamo Mortgage Holdings is.
Mortgage Holdings is an example of a company that actually purchases packages of mortgage notes. So this company is my company. There's several team members that work at this company. And, with this, what we are focused on is actually purchasing packages of mortgage notes. So within the mortgage note business, you've got kind of two categories. You've got people that are buying notes as an individual, and then you have people that are actually, institutions that are buying notes. The thing that's nice about Alamo is if you're interested in note investing, but you really don't have the time to sit there and figure out all of the details on how it works, and you just are in a position where you want to deploy capital, we actually offer a bond that is £100,000 bond where it can be purchased. You can place anywhere from £100,000 to £1 million easily and conveniently. And then that money is actually deployed into purchasing mortgage notes, exactly like the package that was shown. And you've got an entire team that is supporting that to make sure that it is fully backed up. So I hope that helps. I hope that you learned something about mortgage note investing, and that is the end of the presentation.
All right, fantastic. So that basically right there is kind of the key to it. I want to do a couple of reminders. Please take the time to fill out the sign-in sheet. If you have not already done that, your name should be on there. We tried to get everyone's name on there. And it's a good idea to include information on what you're interested in. You'll get a copy of this sign-in sheet emailed to you along with a copy of this recording. And if you have any friends or colleagues that you think would benefit from these meetings or that would be interested, please feel free that next time that you've got a link to just invite them. Go ahead and just give them the link. They're welcome to come. Come one, come all. Okay, so that is it for today's presentation. And now I'm gonna open it up for any questions. So I'll go ahead and stop the recording and then I'll take questions.